Hi, and welcome to part 3 of module 3. So in this part, we're looking at pricing risky assets. So we're going through some ideas behind asset pricing models. So the learning objectives for this part is firstly to explain the relationship between risk and return proposed by the capital asset pricing model. Understand the relationship between the capital asset pricing model and models that include additional factors. Explain the development of models that include additional factors, and distinguish between alternative methods of appraising the performance of the investment portfolio. So the outline of this lecture includes, firstly, we introduce the capital market line. Then we introduce the security market line, which is basically the CAPM model or the capital asset pricing model. We then introduce additional asset pricing factors or risk factors into the CAPM model. And finally, we look at a few ratios where people use to evaluate portfolio performance. So the main purpose of this topic is to look at the pricing of risky assets. So as we mentioned before, the key issue in finance or investment is how do we describe the risk-return relationship, right? So if we were to choose a certain investment, how much return is adequate to compensate for the riskiness of the investment? So asset pricing models are models that try to work out the prices of assets or the returns, the adequate returns of assets, if we assume that investors behave in a certain way, right? So in this case, in most of traditional asset pricing models, we assume that investors behave according to portfolio theory. So they are risk-averse investors who want to maximize returns if at one given level of risk, or vice versa, right? So minimizing risk given a level of return. In asset pricing models, we introduce the risk-free assets. So in this case, the investor has an option to invest or to borrow at the risk-free rate, right? So they can choose to issue risk-free assets, or they can choose to borrow to invest in risky assets, so to buy treasury notes, for example. So the key implication of modern portfolio theory or Markowitz portfolio theory is that in a competitive market, because of diversification, investors should not be rewarded for bearing unsystematic risk, right? So we mentioned before that the concept of diversification brings about the concepts of unsystematic risk and systematic risk. So unsystematic risk is risk that the investors can diversify away by combining different assets that have less than perfect correlations. Systematic risk is the type of risk that cannot be diversified away. So for this kind of risk, it is the systematic risk that investor cares about, right? Because they can't diversify that away. So since systematic risk cannot be eliminated by diversification, investors will expect to be compensated for bearing systematic risk as opposed to unsystematic risk. As a result, asset pricing models are built based on this assumption, meaning that the prices or the expected returns of an asset should only be reflecting the systematic risk component of the portfolio, right? So in the next few slides, we're looking at two important asset pricing models, one for a portfolio and one for individual assets, right? So in the next few slides, we'll look at how exactly do we measure the relationship between risk and returns. So how do we put them into an equation? So we introduce first the capital market line. So the capital market line is an asset pricing model where we are pricing portfolios of assets, right? So in here, this is an extension of Markowitz efficient frontier. So recalling from last week, this is what we learned last week, right? So we're looking at Markowitz efficient frontier. So without a risk-free asset, if all assets are risky, so we don't have any assets with zero risk, like in this case, right? Without a risk-free asset, this is the efficient frontier. So a risk-averse investor would pick any point along the efficient frontier, right? As we mentioned before. With a risk-free asset, when we introduce a risk-free asset into our portfolio, the efficient frontier would now become the capital market line, right? So the capital market line is an extension of the efficient frontier if we have a risk-free asset. So with the opportunity to borrow and lend at the risk-free rate, so in the presence of the risk-free asset, where we could either be investing in the risk-free asset, or we could be issuing the risk-free asset to borrow to leverage our portfolio. So in the presence of this opportunity, an investor can now invest in combinations of risky assets and the risk-free assets in accordance with their risk preferences. So what it means is that if we have low risk tolerance, this is the market portfolio, right? So we'll talk about this point later on. So if our risk tolerance is lower than the market portfolio risk, meaning that we want to be exposed to a risk level that is less than sigma m, right? So what we can do is therefore to divide our portfolio into two parts. In the first part, we invest in the market portfolio like everyone else, and in the second part, we invest in the risk-free assets, right? So when we invest in the risk-free asset, what it means is that we buy the risk-free security, right? So like we buy the government bonds. So effectively, if we are investing in the debt security, we are lending money to the issuer, right? So in this case, we're lending money to the government. So if we have a very low level of risk tolerance, we would be somewhere here, right? So this is where our utility curve cuts the capital market line, and this is our investment portfolio. So this portfolio includes a certain percentage of the market portfolio and a certain percentage of the risk-free assets. On the other hand, if we have a high risk tolerance, we want to be exposed to higher than the market risk. What we could do is that we could borrow at the risk-free rate. So we're assuming here that all investors can issue debt securities at the same rate as the government, right? So everyone has the same credit risk, more or less. So in this case, we want to take more risk than the market, and therefore we want to borrow money and leverage our portfolio, right? So we have, say for example, we start with $100. We want to take more risk, so we borrow $50 at the risk-free rate. We use the total proceeds, so $150, to invest in the market portfolio, right? So in this way, it allows us to be exposed to a higher level of risk compared to the market risk, right? So our risk level is here. This is where our utility curve cuts the capital market line, and this is the portfolio that we choose, right? So in this portfolio, we have 100% of our asset allocation going into the market portfolio, and our money, our capital, includes both our equity plus the money that we borrow. So the line RFMN is tangential at the point M to the efficient frontier of the portfolios of risky assets. This line represents portfolios that consist of an investment in portfolio M, which is this point over here, and an investment in the risk-free assets. So we mentioned before that in the presence of the risk-free assets, our efficient frontier now become the capital market line. So the capital market line in this case is more efficient than curve AB, in the sense that doesn't matter which point that we pick on curve AB, we could always find a better portfolio along the capital market line, right? So for example here, we're talking about this point over here. So let's go with X. So with in the presence of the risk-free rate, risk-free assets, our portfolio is X. Without the risk-free assets, our portfolio is this point over here, right? So we call it X1, for example. So if we compare the returns of these two portfolios, we'll see that the return of X is higher than the return of X1, right? And they both have the same level of risk. So in the presence of the risk-free assets, therefore, the capital market line becomes more efficient than the efficient frontier. So the capital market line can be expressed in terms of an equation, and this is the equation of the capital market line. So on the left hand side, we have the expected return of a portfolio. So it's important here that we're talking about portfolios, right? So with portfolios, according to Markowitz, portfolios are diversified in the sense that only systematic risk is included in the portfolio, remains in the portfolio, because we diversify all the unsystematic risks. So to measure the expected return of a portfolio, we could use this equation here, which is the capital market line. So the expected return of a portfolio is equal to the risk-free rate plus the ratio of ERM minus RF, this is the market excess return, divided by the market standard deviation, so market risk, multiplied by the standard deviation of the portfolio. So this was the x-axis and this was the y-axis on the graph that we saw before. This is the slope of the line. Okay. So the slope of the capital market line is the measure of the market price of risk. So this represents the additional expected returns that the investor requires to compensate for an additional unit of risk. Right. So the CML, or the capital market line, represents the efficient set of all portfolios that provides the investor with the best possible investment opportunities when the risk-free asset is available. So this is what we mentioned before when we look at the graph. So in the presence of a risk-free rate, the tension line going from the risk-free rate that meets the efficient frontier is the most efficient combinations of portfolio, right? Any point below the capital market line now becomes inefficient because we can always pick a better portfolio on the capital market line. So with the capital market line, we're talking about portfolio returns, right? So our measure of risk in the capital market line is the standard deviation of the portfolio. That's because Markowitz assumed that all unsystematic risk is diversified away, and therefore the standard deviation of the portfolio only includes systematic risk, right? Now, the only drawback of the capital market line, at least in theory, is that it doesn't allow us to price inefficient portfolios or individual assets, right? So if we have individual assets, we don't have the benefit of diversification. So in that case, how do we estimate the returns of individual assets? So that's the whole idea of the capital asset pricing model, or the security market line, right? So in this model, we are estimating the returns of individual assets or inefficient portfolios. Okay. So although the capital market line holds for efficient portfolios, it does not describe the relationship between expected returns and risk for individual assets. So in equilibrium, the security market line or the CAPM model says that the expected returns on risky assets could be shown to be following this relationship over here, right? So on the left hand side, we are trying to estimate individual asset returns, and this is given by the risk-free rate plus the ratio of excess market return to market variance times the covariance between the individual asset returns and the market returns, right? So if we rearrange the equation, we have this equation here, or what we call the capital asset pricing model, right? So the capital asset pricing model tries to explain individual asset returns as a function of the market excess returns, right? And this relationship is described by this term over here, and this is what we call beta, right? So beta is simply just the covariance between individual asset returns and the market returns, divided by the market risk, right? So it's basically a standardized measure of covariances or co-movement. Okay. So equation 2 over here is the capital asset pricing model. So what we observe here in equation 2 is that the only relevant risk factor for individual assets is the co-movement or the sensitivity of the asset returns to the market returns, right? So only the common factors, only the contribution of the individual assets to the common movements of the market portfolio is relevant when we measure the individual assets return. Okay. So the covariance term between the individual asset return and the market return is the only explanatory factor in the CAPM model that is specific to asset I, right? So what it means is that only the covariances or only the contributions of the risky assets to the total riskiness of the portfolio matters, right? So if two assets has two different expected returns, that's because they have different covariances with the market portfolio. This is in contrast to the efficient portfolio, right, or the efficient frontier, or the capital market line, in the sense that the capital market line uses standard deviation as the relevant measure of risk. The CAPM model uses the covariances, right, or the beta, or the standardized covariance as the measure of risk. So as we mentioned before, this is the reason is because we're pricing individual assets, right? And by default they are not diversified. Therefore the standard deviation of the asset return itself is not a good measure of risk, right? Because it includes both systematic risk and systematic risk. We only want to take into account systematic risk in our asset pricing model. So to recap, with the capital asset pricing model or the security market line, the relationship between risk and return is measured by beta, right? So beta here is the measure of risk, not standard deviation like before, like the security, like the capital market line, right? So beta here is the covariance, the standardized covariance, not the standard deviation anymore. So under the capital asset pricing model or the CAPM model, the expected return of a risky asset comprises two components. The first component being the risk-free rate. So I'm just rewriting the model over here to make it easier. So the individual asset return is equal to the risk-free rate plus beta times the market risk premium, right? Market excess return. Okay. So there are two components to this equation. The first one being the risk-free rate, and the second one is the risk premium, right? And this risk premium depends on how sensitive the asset return is compared to the market return. Right, so we talked about individual asset beta before. With portfolio beta, the portfolio beta could be calculated as the weighted average of the betas of individual assets in the portfolio, as per the equation over here, where N is the number of assets in the portfolio, WI is the weight or the value of each asset relative to the sum of the total of the portfolio. So how do we use the CAPM model in practice, right? So our goal here is to try to work out the expected return of a certain asset, right? So if we were to invest in PHP, for example, then what would be the expected return for PHP? So to use the CAPM model in practice, we have to be able to measure a few things. So we have to be able to measure the risk-free rate. We got to have an estimate for the risk-free rate. Then we have to have an estimate for the market portfolio, right? And finally, we need to measure the sensitivity or the co-movement between the asset itself and the market portfolio. So there are three things that we have to estimate if we want to use the CAPM model to work out the expected return of the asset. So the first one being a proxy for the risk-free rate. The second one is the systematic risk of the asset, or beta, or the co-movement. And finally, the market risk premium, or just market risk, right? So normally, in terms of the risk-free rate, we tend to use government securities as the measure of the risk-free rate. And a standard measure in the literature is that we use the long-term government securities, right? The yield on the long-term government securities, like the treasury bonds, for example. With beta, so the way we measure beta is that we tend to collect data. So we tend to collect, say, for example, 30 years of daily prices. So we observe over the last 30 years, we observe the daily returns of PHP. Right, so we have the historical time series of PHP returns in the past 30 years. We then observe, say, if we use 30 years as the time horizon, as the estimation window, then we observe the daily returns of a market portfolio. So if we choose the ASX 200, S&P 200 as our market portfolio, then we observe in the past 30 years the daily returns of the S&P 200 index. Right. We then run a time series regression where we have on the left hand side the individual asset returns, the daily returns of PHP, and on the right hand side we have the market returns, right? So by running that regression, we then could obtain for each individual asset, we could then obtain one measure of beta, right? Which is the coefficient of the market return variable in this model over here. So this is what we call a market model, right? So beta here, by this estimation, beta is an ex post estimate in the sense that we are observing past data and we feed past data into our model, into the market model, to work out the coefficient of beta, right? So it's not a forward-looking measure in that sense. It's a backward-looking measure, and the further we go into the past, the more the more biased the beta estimate by the past information. So some examples of betas in Australia. So I think this data is for 2015. So what we have in this table is we have a few companies in Australia, and these are the industries of these companies, right? This column shows the individual betas for each of the companies in this table. And the numbers here shows the sensitivity of each of the assets to the market portfolio, right? So if beta is more than 1, if beta is larger than 1, that means the asset is more volatile compared to the market, right? Whereas with the beta that is less than 1, this is when the asset is less volatile compared to the market portfolio. Market risk premium. So as we mentioned before, in the market model, when we estimate beta, we need to pick our market portfolio, right? So how do we define the market portfolio? We normally use indexes. So say the S&P 200 index or S&P 500 index as the general proxy for the market portfolio. So we mentioned before that with the measure of the market risk premium, or with the measure of beta, we're using past information to estimate the beta and the market returns. On the other hand, we are using the current market yield on government securities as our estimate of the risk-free rate, right? So with the market yields of government securities, those yields reflect the market's expectation for the future, right? For the future performance of the economy. So we have a mismatch over here in terms of the time horizon of our estimates. So on the one hand, we have the risk-free rate estimate being a forward-looking measure. So we're measuring expectations in the future. On the other hand, we have the market returns and the beta being backward-looking, right? So we're using past information to project the beta and the market returns. So they are not really consistent. So another way to get around it is that we could estimate the market risk premium directly rather than using past information to measure market returns. So the capital asset pricing model is a very nice theory, right? So it's one of the most important theory in finance because it lays the foundation for all the other asset pricing models, right? So the idea here is very neat. The idea is quite strong. We're saying that the only thing that matters in terms of pricing an individual asset is its systematic risk, right? So anything that is systematic is priced. Anything that is unsystematic is not priced because by default investors can diversify this risk away. So that means that in an asset pricing model, we should only see systematic risk factors, right? So the CAPM model has a very strong theoretical foundation. However, when we actually implement this model in practice, it's really, really hard, right? So one of the biggest criticism of the CAPM model is that the theory by itself is very vague. So the theory relies on our ability to identify the market portfolio, right? So we're trying to measure our asset sensitivity to the market portfolio. But how do we define a market portfolio? So in theory, the market portfolio includes all possible assets in existence, right? And if we think about the common practice of using a share market index, say the ASX S&P 200 or ASX S&P 500, they are not, by default, they are not the market portfolio because they don't include all the assets. They only include, for example, the top 200 stocks in the market, right? And stocks by themselves are not the only asset class that investors can invest in, right? So investors can choose, for example, besides stocks, they can invest in bonds, they can invest in real estate, so on and so forth, right? So the market portfolio, therefore, by default is impossible to be observed, right? And therefore, the CAPE model itself is untestable, right? And this explains why a lot of the empirical studies trying to validate the CAPE model don't find support for the CAPE model, right? So what it means is that when we try to fit the CAPE model into historical data, we find that it doesn't explain a lot of the variations in the returns. So Role 1972's criticism about the untestable nature of the CAPE model, as well as empirical research showing that the CAPE model doesn't explain returns very well. These two factors motivate a lot of other studies that does not only incorporate beta as the only risk factor, but also incorporate other risk factors as well. So what these people argue is that yes, systematic risk is price, and systematic risk is not price, but the CAPE model misses important other systematic risk factors, right? So for example, in 1993, two researchers, Farmer and French, they come up with a three-factor asset pricing model where they're trying to explain returns using three factors, right? So in their model, they have beta as one of the risk factors. They also have small minus big, so they have a size factor, and they have high minus low, or a book to market factor, right? So what they are arguing is that besides beta, the size of the company and as well as the market valuation of a company also reflect systematic risk, right? Reflect the systematic risk of the company. So what they find empirically is that their model, the three-factor model, explains returns much better than the CAPE model, right? So later studies argue that even though the additional risk factors, so multi-factor asset pricing models, appear to be able to explain returns, they might not be consistent with the systematic risk argument, right? For example, in 1977, Carhart, he shows that besides the three factors in the Farmer and French model 1993, another factor could also explain returns, which is the momentum factor. So what we mean by the momentum factor is that he finds that the winner stocks in the past 6 months tend to continue to win, and the loser stocks in the past 6 months, they continue to lose, right? So if they construct a factor of winners minus losers, and they include that factor, which is what they call the momentum factor, into Farmer and French three-factor model, they find that the model performs better. So therefore, his four-factor model outperforms the three factors model by Farmer and French, right? So what Carhart argues is that the momentum effect is definitely not a systematic effect, right? So it doesn't reflect systematic risk. The momentum effect by definition reflects the investors' irrationality, right? So investors tend to overprice winner stocks, and they tend to underprice loser stocks. and this is not meant to be systematic risk, right? So by this finding, Carhart argues that yes, additional factors might explain returns better than a CAPM model, but they are not consistent with a risk argument, right? It could be irrational. It could be irrational factors that could also be priced. Okay. So that questions the risk-based explanation of the beta factor, or it questions the heart of the CAPM theory, right, or modern portfolio theory. So what is it exactly that drives returns, right? If it's not risk, then what is it, right? So despite all the limitations and all the evidence against the CAPM model, it's still one of the most widely used model in practice, right? We then talk about different ratios that investors use to evaluate the portfolio performance. So to evaluate portfolio performance, we need to have a benchmark. We need to compare our portfolio returns with a benchmark, right? So some of the reasons why a portfolio might outperform or underperform the benchmark is because of the investor's ability to choose the right asset allocation, to time the market. The investors might have abnormal or superior security selection skills, or there might be some random factors affecting the returns, right? So to measure portfolio performance, we have the most simple method, which is to compare the portfolio returns with an index, right? So say we have the S&P 200 index. We could also use the Sharpe ratio. This is one of the most commonly used ratios in the industry. So with the Sharpe ratio, what we're doing here is we're measuring excess returns per unit of risk, right? So the Sharpe ratio is given by the difference between our portfolio return and the risk-free rate. So this is the excess return of the portfolio over the portfolio total risk, right? So the Sharpe ratio therefore tells us the additional dollar return given $1 unit of total risk of the portfolio, right? So we compare the Sharpe ratio of the portfolio to the Sharpe ratio that we get from the benchmark. If we have a higher Sharpe ratio, that means that our portfolio is outperforming, right? So the measure of risk here with the Sharpe ratio is the standard deviation of the portfolio returns, right? So we're assuming here that the portfolio is well diversified. So the only thing that we have here is the systematic risk. We also have the trainer ratio, where it's very similar to the Sharpe ratio, but the risk measure here is the beta, right? So we measure directly the systematic risk of the portfolio, right? So we're saying that the only thing that matters for our portfolio is the systematic risk, which is beta. So similar to the Sharpe ratio, we compare the trainer ratio of our portfolio to the trainer ratio of our benchmark, and if we have a higher trainer ratio, that means our portfolio outperforms, right? And vice versa. Okay, so to summarize this lecture, or part 3 of portfolio theory, so we mentioned before that diversification means that investor can construct efficient asset portfolios, and they should be investing only on the efficient frontier, right? If they are a risk-averse investor. In this lecture, we're looking at applying the diversification concept into asset pricing, right? So if systematic risk is the only risk that cannot be diversified away, then the investor should only be rewarded for bearing systematic risk, right? So they should be rewarded only by bearing the proportion of the asset risk that is contributing to the total market risk. We then introduce the CAPA model. So the CAPA model is the model where we use to measure individual asset risk returns given the asset's sensitivity to the market portfolio. So the CAPA model assumes a linear relationship between expected returns and risk, and the slope of the relationship is given by beta, which is the standardized co-movement between the asset returns and the market returns. Although the theory is very nice, but in practice we'll find that it's very hard to implement the capital asset pricing model accurately. So it's very easy to implement, but it's hard to implement it correctly like the theory states. So later on, people show that additional risk factors besides beta could also affect asset returns. But the risk-based explanation under the CAPA model is debatable, right? So some people show that not risk-based asset factors could also affect returns, like the momentum factor, right? In the final part of the lecture, we look at different ways or different ratios that people use to evaluate their portfolio returns. Right? So that concludes module 3 of 2070.